Imagine running a business where you only track money when it physically comes in or goes out. Sounds simple, right? But what if you complete a $100,000 project today and don't get paid until next month? Does that revenue just vanish for now? This is exactly where the matching principle and accrual accounting come into play. In this video, we'll break down these key concepts, and by the end, you may have a new perspective on how businesses track revenue and expenses. One of the core principles of accounting is the accrual basis, which ensures that expenses are matched with the revenue they help generate. This is in contrast to the cash basis, where transactions are recorded only when cash changes hands. While the cash basis may seem simpler, it can distort financial results by making a business appear more or less profitable than it actually is. How come? Because the business owner could manipulate when expenses are paid or cash for revenue is received. There's a lot of room for financial manipulation. Under the matching principle, revenue is recognized when earned, not necessarily when cash is received. For example, in a cash sale, revenue is recorded immediately. But if a company provides a service today and invoices the client for payment next month, the revenue is recorded now because that's when it was earned. Some industries, like software and subscription services, follow complex revenue recognition rules to ensure compliance. The same concept applies to expenses, which are recorded when incurred, not necessarily when cash is paid. If a company uses electricity in December but doesn't receive the bill until January, the expense still belongs in December because that's when the electricity was used to generate revenue. Accountants spend significant time ensuring that revenue and expenses are properly recorded. This is especially important in industries with long-term contracts, subscriptions, or complex sales structures, where improper recognition can lead to misleading financial statements. Adhering to the accrual method and matching principle ensures that the financial reporting accurately reflects the company's performance, providing investors and stakeholders with a true picture of profitability. Revenue recognition is a critical process for businesses, especially in industries like software, subscriptions, and services, where determining when to recognize revenue isn't always straightforward. Take a software license, for example. You pay at the beginning of the contract period, but the company doesn't recognize all that revenue up front. Instead, it's recorded gradually as the contract period slowly expires. To ensure consistency and compliance, businesses follow a 5-step model for revenue recognition. 1, determine whether a contract exists. 2, identify performance obligations. 3, determine the transaction price. 4, allocate the transaction price. 5, recognize revenue as obligations are met. These steps might sound simple, but the process is anything but simple. I've worked for a larger software company, and it had a separate accounting team that just worked on revenue recognition, the related policies, and audit documentation. Matching expenses to the revenue they help generate is a key part of accurate financial reporting. During the month-end close, accounts ensure that all expenses are properly recorded, even when the invoices haven't arrived or exact amounts are uncertain. One challenge is accruing expenses when the exact cost isn't known. For example, if a company is facing a potential lawsuit, accounts work with the legal team to determine if a settlement is likely. If the estimated range is $10,000 to $50,000, the company typically records the lowest probable amount, in this case $10,000, to ensure financial statements remain accurate without overstating liabilities. Another complex area is prepaid expenses, which must be recognized in the correct period. If a company pays upfront for a year of insurance, it doesn't record the full expense immediately. It's spread out over the coverage period. In industries like insurance, actuaries and accountants estimate expenses using mathematical models. For example, health insurance companies don't know the exact amount of claims that will be submitted in a given month. So they rely on historical data and statistical models to record an estimated liability. Accuracy is critical here. A small miscalculation in an Excel model could lead to a significant financial misstatement. By properly accruing expenses and recognizing them in the right periods, businesses ensure their financials reflect reality, giving stakeholders a clear and accurate picture of profitability. And that's a wrap on the matching principle and accrual accounting, hopefully in a way that kept you engaged. By recognizing revenue when earned and expenses when incurred, businesses ensure a more accurate and transparent view of their financial health.